So let's get into the presentation. Again, this presentation is about international investment opportunities during a recession. My name is Jess Roberson, and I'm a part of WHVP, which is a wealth management firm based in Zurich, Switzerland, and we help Americans diversify outside of the US. All right, so before we get into it, excuse me, I would like to show you a slide. This morning, I woke up and thought, I read the news constantly, but what happens if I search a US recession? And these are the headlines that popped up. As you can see, there's different headlines that pop up in the media. It's something that's being talked about constantly. Really, I feel like it's been being talked about for the past year and a half. But these are kind of the recent headlines. And one that really stood out to me, which we'll get into a little bit later on in the presentation, is that bold one in the middle of your screen of consumers are keeping the US out of a recession. It's getting harder. And so we might have a call back to that throughout our presentation. So just keep that in mind as we get going. All right, so what are we going to cover today? We're going to talk about the signs of a recession, what a recession is, what the U.S. Economy and some of the indicators are. Then we're going to talk about those investing during a recession, what that looks like, what are the opportunities that exist, and what potential do they offer. Then we'll talk about working with an independent asset manager and what that is like, especially for Americans working offshore, and then offshore investing with our company, WHVP, and what that looks like and how we help people. Before I get into it, I'd like to introduce myself a bit more. For those of you who don't know who I am, my name is Jess Roberson. At WHVP, my roles are investment research, client onboarding, and marketing. I also assist the managing partners with any back office work that they need and anything around the office. As a little personal GIF or interesting fact about who I am, I currently play rugby with the Swiss national team. I enjoy pushing myself to the limits mentally and physically. As you can hear, my accent is not Swiss. I am an American. I met my lovely wife in the South Pacific in 2015. We got married in 2017. I've been here ever since. I studied finance at Southern New Hampshire University as well. I minored in international business, and I'm fluent. Obviously, my mother tongue is English, and then I speak German and the dialect of Swiss German. All right, so enough about me. Let's jump into this presentation. So when looking at the definition of a recession, there's been a lot of semantics from economists, from politicians, from central banks. So I just looked up the definition and put it here from Oxford Languages, which is a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by the fall of gross domestic product or GDP in 2 consecutive quarters. In July 21st, 2022, the White House got out ahead of the economy or the economic reports and stated boldly that they were not in a recession, and said that it was semantics to say they were in a recession, regardless of if the second quarter of 2022 was negative and if the U.S. economy had contracted. It did contract, and they still stuck to their point that the U.S. was not in a recession. I mean, they said that the National Bureau of Economic Research usually prescribes a recession after the effect. So it didn't really matter if they were in a recession. They would find out later when it was officially charged. So there's been some play there, but this is what the definition of a recession is, and I think it's important to discuss that. All right, so what are the current U.S. economic factors that we're looking at, that we're trying to view and be forward-looking? Obviously, you have to use historical information to track things, but at the same time, we look at what's happening currently and moving forward. So the first is that American savings are depleting. If you go back to 2021, the American public had about $2.4, $2.5 trillion in savings. You come to today, they have $900 billion in savings. That means $1.5 trillion in savings has gone out of the American public's savings accounts. They don't have a lot of cash on hand in general. The second is when we look at this chart here on the left, which is the economic forecast of Dr. Bill Cornely, using data from the Bureau of Economic Analysis. He is predicting that there will be a downturn in the second quarter, third quarter of the third and fourth quarter of 2023 and moving forward. Part of this is because there's sticky inflation, which we see at 3.7% in Switzerland, which is actually an increase year on year, and the basis effect seems to be wearing off. And so this 3.7% isn't 3.7% on the month, it's 3.7% higher than it was last year at this time. So inflation still is remaining incredibly high. And part of the reason is the Fed, the central bank of the US, has to deal with two mandates. They have to worry about unemployment and price stability. And this creates a little bit of a inefficiency in how they have to act because they're not focused on one mandate and have to keep both in mind as they try to fight certain negative numbers, whether they be unemployment or price stability. And either way, the Fed usually uses the interest rate to control that, and they're less likely to move that interest rate because, or maybe not move it as much as it should, because they're trying to weigh the effects on two different mandates they have. The next economic factor, which I'm sure many of you Americans are aware of, is the government debt of the United States, which is at 3.294 trillion, which is, or 32.94 trillion, excuse me, $33 trillion. This is wild. The US debt ceiling has become, unfortunately, seemingly political bargaining piece for either party, whoever's party's interest is to slow things down and then get the money spent on what they want. But both seem to be continuing to raise the debt ceiling, and there's no plan in the presidential budgetary office or the fiscal policies to slow the spending of the United States government. So there's no real debt break in the United States. And then finally, some of the factors that we're looking at the US in terms of a struggling economy is the de-dollarization, the global trend of de-dollarization, with other countries' central banks buying up gold, filling their gold reserves, and starting to trade commodities and even other products such as oil in different currencies, which is a slow trickle away from the US dollar. There's been open talks about trying to get away from the US dollar. And this threatens the value of the US dollar, which has already been losing value over the past 100 years, even in the past 10 years, past 20 years, past 30 years, has been on a downward trend, and we don't really see that changing. So what are the further signs of a recession that we want to look at specifically? Well, if you look at the US labor indicators, they see a downward trend. They've had 16 consecutive months of a downward trend, so they don't have there's not a lot of confidence in the consumers as well as in the businesses. I mean, 16 months is a long time, and it's just this gradual decline, and it seems to be being kicked down the road constantly. We see consumers again with lower confidence. They're starting, although they have been spending for the past year, they're starting to put off those big purchases, and that's already a sign of, spending is getting thin. We have to be a bit careful. Credit cards are being maxed to the limit. Last month, credit cards hit the use of credit cards of the American public hit $1 trillion. It's the first time it's ever done that. As you can see in this graph, you have the Federal Reserve's consumer output of debt, and it's skyrocketing. In the red, you have the loss of personal savings, which we talked about on the last slide. So you see debt is being used to keep spending, and the savings are being used. So like we said, that debt of credit cards has went up $1 trillion. It's hit $1 trillion. So, where is the rest of this money that has been lost? And it's because the American consumer continues to spend. Eventually that's going to run out, and then it's going to cause an even stronger recession to hit and be felt much stronger. Then banks are much less likely to lend. The Fed did a report where they talked to the banks, and banks told them in all of our lending categories, we are going to become stricter on lending due to a lot of delinquencies, especially in credit cards. And so they're really looking to tighten their lending practices to the public. So eventually, this credit that is holding the U.S. economy up and the spending habits is going to be decreased even more. Again, looking at that definition of a recession, when industrial activity goes down, we see manufacturing now for the past 10 months post-pandemic restrictions has still been declining. This is dangerous because it's just reduced activity in the industrial industry, and it sets up for a potential lack of supply, or then either shows a lack of demand for something. And again, bottom lines are hit, the economy goes down, GDP falls. Then you have the Treasury bill yields curve. It is currently inverted. The last time it was inverted was in late 2019, before the hit of the last recession we had, which was the COVID recession, which was unprecedented. But as a general rule, when you're looking at recessions, when the Treasury bill yield curve inverts, meaning the 2-year yield bond is a better investment than the long year or the 10-year Treasury bill, then in the next 18 months, they expect a recession to hit in some form or another. Currently, it's been 14 months, so we haven't seen that recession, but we're still in the time frame, and it would be surprising if this kind of general rule doesn't apply in this case. So that will be interesting to see. As we mentioned, inflation remains an issue in the US. It's sticky, and we're going to see if it continues to rise. Is it going to flatten out? And it's dangerous to go into a high inflationary environment into a recession. So, what are the investment opportunities in the midst of a recession? First, a general rule of thumb, which many investors know, is diversified. A diversified portfolio helps to reduce the volatility in that portfolio. Now, that is in good times and bad times. And we're going to look at that a little bit later on in more detail, but that's where you have to really start. The next is the industries we like to look at, or the sectors of the market, are the healthcare, which include biotech and pharmaceuticals, and consumer staples. These are industries where people need to keep spending just to live or to stay healthy and to carry on with regular life, and in general seem to present quite an interesting opportunity in the midst of a recession. All right, so looking at a globally diversified portfolio, we're going to look at a perspective in these two charts of a US invested portfolio. As you can see here on the left, this is the average annualized change in portfolio volatility when adding non-US stocks to a portfolio. So what you're looking at is where that starts on the left and goes below zero. That's the reduction of a portfolio in volatility. On the bottom, what we're looking at is how much of your investable wealth is invested outside of the US dollar. This is a study that was done by Vanguard, and it's brought out some very interesting facts about diversification outside of the US, specifically into international investments. You can see the two lines. You have a 60-40 typical investment portfolio and 100% stock, and you see the best, the right amount of money where you're getting the most amount of reduced volatility is right between 20 and 30%. If you put a time frame on it, you say, okay, let's look at 10-year time expected reduction in volatility. That moves just a little bit over to about 24 to 25% to 35% of your investable wealth invested outside of the US into international stocks. So this is quite an interesting two graphs that really show the value of investing outside. And you may say, hey, look, it looks like it's about 3 or 4% reduction in volatility, but that's what you want. You want any reduction of volatility, especially in times of economic crisis, because it stabilizes things and you don't get the up and down, and it helps you know, or at least sleep a little bit better, knowing I have less volatility in my portfolio. All right, so now let's look at the healthcare sector outside of the US. So what we have here on the right is 3 indices that are fairly similarly allocated in terms of companies that they're holding in the healthcare sector, and they're outside of the US. They exclude US investments. As you can see here, in August 2008, during the Great Recession from 2007 to 2009, you see this great time period of an opportunity to hit. Again, this is historic. We're looking at it, so we'll look at a few periods, but you see this time period where you can invest and then see you can reap the benefits as you pull out, as the economy pulls out of that recession. In 2009, these indices were were positive 19.84%, which is a large number. It's good. They had good growth in 2011 when there were some more financial troubles in the US, and 13. As you see, they have a nice curve. They don't flatten out until there's a lot of, a stable economy where people start spending money in other places. But again, the trend is still up. What's interesting about these indices is that the largest positions in these index are actually Swiss companies, and they make up over 17% of these indices. So that means out of the 150, I think, to 160 companies that are held in these indices, 17%, which is a high percentage of that indice, is in Swiss companies. It's interesting if you look at the technology innovation that's being pushed into the Swiss healthcare sector. There was an estimation that there's going to be $8.2 billion of potential to improve the healthcare sector, not only for the patients and those using it and needing access, but the stakeholders as well to profit from them. All right, so let's look at the consumer staples. Again, excluding the US, similar indices here. Again, just like the healthcare sector, you see this nice little time frame to jump in 2008. You have good options in there. Even if you hit your high point in 2009, you see growth. If you time the market perfectly, which we never try to do, we never say that we do. It's about time in market, not timing the market. Then you still see in 2009 there was a 36.34%. So people really spent on what they needed in 2009, and the sector saw a large growth during that time period and continued to grow well even in 2012 and 2013 with small hiccups. But again, that continual trend up is really nice to see. If you look at the 30-year gross return of these indices, you're looking at 5 to 8% a year, which if you even take the lowest, you're looking at potentially 150%, which is amazing over time. Again, here, what's very interesting in this, these are the foreign stocks. The largest position held in these indexes is a Swiss company, and it makes up over 16%. Again, heavily weighted in the Swiss consumer staples markets. So I've talked a lot about Switzerland. It's very interesting, but why am I talking about Switzerland, and why is it that these companies make that up? Well, first, we need to look at the Swiss economy and how it's run and why there's so much trust or weight on these Swiss companies. And so you need to look at the Swiss environment. So here we're going to talk about the economic outlook. We're going to talk about the Swiss National Bank, which is the central bank of Switzerland, which has only one mandate, which is price stability. So they don't have to worry about employment. The government says, we'll take care of employment. You take care of price stability. We can be more effective that way. And so they've set their inflation range year on year between 0 and 2%. The US says we want 2% exactly. It's a hard mark to hit, but the US always floats around 2, 3, maybe 1.5%. On a good year. In a bad year, we see it going up obviously to 9% and holding at well above their target. Switzerland's current level of inflation is 1.5%. Their highest level of inflation in the inflationary periods that we just saw with high inflation in the EU, in Great Britain, and the US. Switzerland hit a peak of 3.5% last year when the US was around 9%. Again, Switzerland is able to act quickly and efficiently in solving their problems. And that's because their central bank is focused on that price stability, and it creates a nice economic environment for companies because they don't have to deal with domestic turmoil. The government focuses on the unemployment, if anything should be spent for that, and the central bank focuses on the price stability of the currency and what's being traded. So they don't have to worry about the devaluation of their currency or overvaluation of their currency. They can really just focus in on what they do best. Switzerland is a wealthy nation with a government with high reserves, as well as a central bank with high reserves, and they have low debt. Switzerland has a debt break that they set at 42% of their GDP, meaning instead of having a number that's their debt break, they have a percentage. So if their GDP grows, they can have a little bit more debt. If it shrinks and their debt goes above that 43%, they have to cut back. They have to figure out how to spend correctly, and it allows them to really spend effectively in the programs that they do spend, and it gets allocated well. When you look at the projection of what Switzerland's going to do in 2024, it is actually projected to do more GDP growth or gross domestic product growth in percent than the US. So it's a smaller economy, certainly, but it seems that it's been set up in a way to really weather the storm that's coming. All right, so we've talked about Switzerland, we've talked about the industries that you can look at when investing, and now we want to move into the portion of how do you get involved, how do you invest in these sectors to get the maximum benefit out of it. So first, I want to talk about the setup that you have that allows you to have a partner with you going overseas and helping you create that nest egg, create that portion of your wealth invested outside of the US. So as you can see here, it's the setup. The client is the pinnacle of the relationship. The asset manager or wealth manager works with a limited power of attorney with the client and has already set up contractual agreements with private banks, top-level private banks, and they go with you and introduce you to the bank and help you onboard at the bank. So you don't have to be in person. You have a partner who's on your side who guides you through the account opening process. The account is in your name, your trust's name, your LLC, joint, or your IRA. So it belongs to you. The asset manager only works with a limited power of attorney. All right, so what are the benefits of an offshore bank account? First is you get an independent partner. It's when you go to a bank, they have products, or you go to a financial institution that's large, they're also creating products for people to invest in. So you might get stuff in your portfolio that does benefit you, but also benefits them even more on top of the fees that they charge you. So an independent partner really has the weight to be on your side and doesn't have that conflict of interest to solve problems and make sure that investment decisions are made solely on the basis of your benefit. Then you have direct access to owners. Often wealth management firms are much smaller, and the owners are very much involved in the day-to-day if they're not managing you as their client directly. And this creates for a lot of continuity and problem solving. So if you go to a bank or a financial institution, these big organizations, there's high turnover rates. So you might like your relationship manager, you might like the bank, but every 2 years you get a new relationship manager and you have to start from scratch and building that trust. With a independent wealth manager, you can change banks, you can stay at the same bank, have multiple accounts, and have one relationship manager who's on your side, who really works on your behalf. Then you have geographical diversification and portfolio diversification outside of the US. Let the specialists who are specialized in the US invest that, and let the specialists who are specialized in investing outside of the US help you to the biggest extent. The geographical diversification is great for asset protection and enhanced privacy, as well as creating that nest egg outside of the crazy political or the not crazy, but the volatile political and economic situations that happen in the US and the forces that push it back and forth in a safe jurisdiction like Switzerland. They have the Swiss Banking Privacy Act, which protects your information from being shared, much like a lawyer and a doctor client relationship. The banks have the same thing. It has to be kept private. And this allows you to enhance your privacy, as well as it puts the burden of protecting your information, your banking, whether you have an online login, to put to the highest standards the need for data protection. Then you have protection against devaluating domestic currency. You look at Switzerland. The Swiss franc has been strong. Actually, in the past 23, 24 years, the US dollar has had a cumulative 75% of inflation, and the Swiss franc has appreciated, gained value against the US dollar at 77% in the same time period. So you get it out of the US dollar, and you get to preserve the purchasing power of your US dollar at the same time while being invested. And again, as we mentioned, it offers enhanced overall stability. So let's jump into the investments and how we make investments, and how we approach that. So we're long-term capital preservation strategists. We're not day traders. We're not trying to get the quickest buck here and get out quickly. We look at investments over the long term, and we exclude the US market and the US dollar. We do this by direct investments in stable economic environments, stocks, bonds, precious metals, and foreign currencies. And then how we go about selecting those things is we look at the country and the currency. We look, is the country set up for success? Is the currency, does the central bank manage it well? Does it have potential in the international level to hold its value over a long time? And then what are the strong industries in that country? What's kind of the industry backing the strength of the economy? And then once we identify those industries, we look at the companies there, the big players, the strong players who have done a good job and who are set up for the future. And we really dive into the technical analysis, and we analyze also the company itself and their governance to look, are they set up for a sustainable model in Europe based on the laws and regulations and the atmosphere and the environment that are in their home country and surrounding in the business that they're involved in. All right, so now I'll introduce our services to you quickly. If you have any questions on these, please just write us an email, because I'm going to go through this fairly quickly. We have our asset management service in the middle. This is by far our most popular. It requires a minimum of 500,000 US dollars. It has a management fee of 1.5% per year. The services you get with this are tailor-made portfolio. So looking at what your financial situation is, what your investments are, your overall structure, and creating an investment portfolio that matches that doesn't overlap or cause you to be invested in too many of the same industries. At the end, we're looking for diversification, but we also want to be diversified through all the aspects and be a portion of your total investment portfolio. There you also get your choice of custodian bank. And then to your choice, up to 4 times a year, we have a meeting with you where we talk through the investments, explain what's going on, and how we see things. Then we have our permanent portfolio service. This offers people the chance to enter the offshore investing world, to dip their toes in the waters. With 250,000 US dollars, this is a 1.2% a management fee per year. It's a standardized mandate, meaning we've done a bunch of research on companies, and we treat every client in this category the same, so they get the same investments. And you don't get the choice of custodian bank here because of the reduced size of the account. We've had to set up a special contractor agreement. So that's what differs between the asset management service, and also why the pricing is a little bit different. Then we have our concierge service, which is a flat fee of 1.5 or management fee of 1.5% per year, minimum investment 1 million, and a flat fee of 10,000 Swiss francs. It's similar to the asset management service, except you get a personal yearly visit. Wherever you are, we come visit you to discuss things, to see how things are going, and discuss the investments and your situation, as well as a concierge service. If you're interested in, let's say, Rolex, but only Swiss people can buy it, we'll help make sure that we can get that for you. It's important to note here that all of our services are available for personal accounts, joint accounts, IRAs, trusts, and LLCs. And you can have multiple accounts at multiple banks if you're looking for that as well. All right, so what's the process? How do I get my money? Or how can you use us to get your investments outside of the US started? Pretty straightforward process. First, is you schedule a 45-minute consultation for free. We sit down, we talk with each other. You get to know us, we get to know you, your financial situation. We have an understanding of what you're interested in, what's your motivation behind moving the finances out, and what that looks like when we reach a mutual decision to work together with each other. You provide some background information on you that we can present you to the bank. We get the documents. Those documents are filled out and completed by you and then returned, and the bank account is opened. Once the bank account is open, the funds can be wired to your offshore account. And when the accounts are in, or when the funds are in, we've been working on creating a portfolio that's going to fit your situation. We set up an initial investment meeting with you to go over those investments, to explain to you what's going to be invested and why we think we have come to this decision of why it's going to be good for you and your situation. And then we make the investments once we've had that meeting. We don't invest before we have the meeting because we want our clients to always know what's happening and to understand why investments are being made the way they are. Then we stay in touch. We keep our clients updated. As I mentioned, depending on what service you have, up to 4 times a year, we have those calls with you to discuss your portfolio, discuss what's been going on and what we're thinking, what the markets are looking like, and what the overall environment is. We send out every 6 weeks our market analysis and report, where we talk about what's happening, as well as we are always constantly on social media updating those things that we hope to link you to, as well as we email you and we want emails from you when you have questions. Again, with our clients, we always want there to be open communication at the highest level. All right, so now you can see our team underneath here. This is our entire team. Starting from the left, you have Danny Collar, who's our legal and compliance. You have Julia Fernandez. She's a managing partner with us. She's been in the Swiss private banking and financial services industry for 30 years. She's been with us for over 20 years. She's an absolute powerhouse when it comes to understanding the system and getting things done and working. And she really provides a lot of experience in a holistic way when it comes to wealth management. I myself am in the middle. You know me. Jamie, she's our CEO. Her and her husband Urs, just right of her, purchased the company 3 years ago and done a really good job in leading us so far. They're both managing partners and relationship managers. So we are going to now end this presentation. If you have any questions, you can write us at info@whvp.ch. Also, some further resources before we get going with the question and answers. You can find our website at whvp.ch. Again, our email address. You can even give us a call if you'd like to. Our number is here. We have a blog that we put out weekly where we talk about topics that are focused to help people interested in diversifying offshore get to know the landscape and understand it a bit more. So that's a great resource if you're still wondering or needed to do due diligence and lift your knowledge of the sector or industry. You can look there. Then we have our Swiss Money Secrets podcast, which is a resource where we sit down and you get to know us on more of a personal level and what we see going on in a discussion format. It's quite good. We actually just released one on the BRICS meeting. If you're interested in hearing the Swiss perspective on that, I would certainly recommend checking that out. You can find that on YouTube by simply searching Swiss Money Secrets, or you can wait until you get the slide deck tomorrow morning and click on the link here. We have a YouTube channel where we also put out short videos for educational purposes, so people get to know kind of the background or what happens in different situations or scenarios regarding your offshore holdings. And then you can follow us on LinkedIn, Facebook, and Instagram as well.